Hi, good evening, everyone. Welcome to our podcast episode 23. So, today will be a very exciting topic regarding liquidity pool and stake mining. So, very warm welcome again, and let us get on to our topic. So, today we are talking about liquidity pool and stake mining in crypto. So, this presentation, I will actually do an overview about what is liquidity pool and also stake mining in the cryptocurrency space. So we will actually also discuss some benefits, risks, and best practice that will navigate this allow you to navigate these tools. So what is actually liquidity pool? So liquidity pool are pool of digital asset, typically comprises cryptocurrency pair. It might be Ethereum over USDT or Bitcoin over USDT or UBX over USDT. So it can be also Bitcoin versus Ethereum if there is pool in the DEX decentralized exchange having that. So there are many kind of pool, but it will always come in pairs. So this pool enable the exchange of tokens, facilitating digital trading and generating trading volumes. So this liquidity pool actually consists of liquidity providers who actually contribute token to the pool so that traders could utilize the pool to exchange for the tokens they need or they want. So generating fees for the liquidity provider. Okay. So how does this liquidity pool works? Okay, first important is actually we need to understand liquidity pool actually operate using the automated market maker. So which in short we call it as AMM. So this automaker will actually determine the price of the token based on the ratio of the tokens in the pool. So they actually determines the price of the pool. So when a trader wants to exchange token, they will need to interact with this AMM. Then the pool, the ratio of the token in the pool changes and affecting the price and enabling the trade. So with liquidity pool, there will not be any admin. There will be only this automated market maker. So every transaction would leads to a generating a fee, which is we call it as a gas fee. So this gas fee will actually has a percentage that will actually distributed to the liquidity provider as an incentive for providing liquidity. So let me give you an example. So I let's say we are in a supermarket. So this supermarket actually consists of a lot of tokens. So we take the Apple as one of the tokens. So one side of the shelf holds specifically a cryptocurrency like maybe Ethereum. Okay, so it has to have an equal amount of tokens in the other side to hold, which usually are the USDT. So if you were to want to get this token A, you will actually have to put the token B, which is maybe the USDT in this reference. You then can actually get the token A, which is probably I use the supermarket as an example. So probably token A is the Apple. So you can actually take the Apple out. You need to place in the USDT. So this is to make exchange without anyone. So who is the cashier? No, the customer first. Let us take a look at the customer. When shopping need trader comes into the pool to exchange token for one or another. So based on their investment strategy, so this actually aims to provide from price fluctuation or to use different tokens for various purpose. So the customer that goes to the supermarket will actually look at what they want. So there will always be a pair in the shelf. They will just have to replace, put in the USDT to take out whatever token they need in that pair, which is we call it as the pool. So who is the cashier in the supermarket? So it will be the automated market maker. So this automated program manage the shelf balance and determine the exchange rate. So they will determine how much is quantity of the apple, and actually they determine how much does it worth. So there will be a price, exchange rate for people to actually take in and out from the shelf. So they actually also ensure the fair price for each token based on the supply and demand in the pool. So buying and selling, swapping of tokens, trader actually deposit one token into the shelf and receive the equivalent amount of the other token. So the price of each token change slightly with every swapping, reflecting a dynamic balance. So we need to know the pool is why does it always come in a pair? Because it always balance up. Always, let's say, later we'll be talking about the liquidity pool, how to be a provider. You have to actually put 50% worth of token A and equivalent amount of token B into a pool. Then you can actually be one of the provider inside. So these are stock. So who is the one who stock up the shelf? Like just now I mentioned, if you want to be a pool provider, the you can actually initiate to actually put deposit the liquidity to, let's say, there is this liquidity pool consists of BNB and USDT. So you can actually also obtain, probably you get you purchase some BNB and also equivalent amount of USDT, and you can add into the liquidity pool. So provider can earn rewards for their contributions, creating a cycle of liquidity. So what are the rewards usually given in? So assuming if you are participating in the pancake swap, most they will actually have this thing called cake, which is actually their reward. So every cake have their own value as well. So they can actually exchange or even do staking using it. So later at the end of the part, I will actually share some example about the staking. So let us now take a look at what is the role of the liquidity provider. So actually liquidity provider can be anyone like trader, like individual, or even institutions. They can actually just whoever want to earn from probably earn the rewards, they can actually be the provider. So they actually need to contribute equal value of two tokens into the pool, creating a balanced liquidity. So from here, traders can actually use the pool to exchange token. So while this exchange will make there will be impact in the ratio tokens within the pool. So this will cause the price difference, and the automated market maker will actually calculate what is the price supposed to be and actually set the price in the liquidity pool. So as trader occur, fee are generated. So this fee usually is the gas fee of the blockchain. So if you are using a Ethereum blockchain, the fee will be Ethereum. So like for Pancakes, the Binance Smart Chain, you'll be actually receiving BNB as a reward. So different blockchain will actually have different uh, liquidity pool provided in the decentralized exchange. So what is the benefit of providing liquidity pool? So people can actually, let's say they have this asset, they actually do not know what to do with it, they do not know how to trade, they can actually earn passive through earning fee from trading activity inside the decentralized exchange. So by contributing to a liquidity pool, support the growth and the development of the decentralized finance ecosystem. So liquidity provider can actually also hold token in the liquidity pool, which actually can benefit from potential appreciation in the value of those tokens. So assuming when you actually put on in the liquidity, the price of the token is actually valued at $100. So when the price of it has increased to $200, your asset in this liquidity pool will also be increased to 1 time. So this is how we actually get the uh, capital appreciate, your investment appreciated. So let's take an example of the Uniswap. Uniswap so far is actually largest decentralized exchange that actually has a lot of different pairs, different token pairs, and they actually have this Uniswap liquidity mining. So how does it works? Okay, so as a leading DEX, DEX is actually in short for decentralized exchange, leading decentralized exchange with the liquidity pool for various crypto asset. So there is a lot of community doing liquidity pool in Uniswap. People, if wanted to actually exchange for token, they will actually go into this DEX to actually swap for the coin they want. So how it works? So the user, which also consider the community, can actually provide liquidity to earn trading fee and Uni token as a reward. So remember I mentioned there is a reward for being a liquidity pool provider. So in Uniswap, this instance is actually using Uni tokens as a reward for the liquidity pool holders. So what are the challenge? So the challenge actually, let's say if you are working on Uniswap, the gas fee is actually quite high, probably a $10 over. So this fee is high, but it's also providing transaction. Some percentage of it will actually be part of the rewards for the liquidity providers. So actually what Uniswap make, it actually made an impact of billions of TVL, which we call it as total value locked. So this significant influence the defined space because with a lot of uh, tradings occur in Uniswap, it actually also provide data for the maker the value for the tokens. So after we have learned about what is liquidity pool, now we actually take a look at what is stake mining. So actually stake mining is actually popular method of earning rewards in the crypto world. So it's similar to liquidity pool. It's not similar to the liquidity pool because stake mining actually uh, allows you to earn reward by holding or locking the crypto asset that you have. Okay, liquidity pool holders is actually providing liquidity and they can actually remove it as and when they want and when they actually do not want to receive any more rewards or do any contributions. But stake mining is different. Stake mining is by providing this asset to the particular network, and this network actually will give out the rewards based on their programs or based on their system. So let's take a look. Stake mining is actually a consensus mechanism. It uses the proof of stake blockchain, whereby holders of a cryptocurrency stake their coin into a secure network. So stakers participate in validating transaction and creating new blocks. It will actually allow them to earn rewards for the contribution to the network security. So let us take a look how does it work. So usually stake mining, it actually user actually lock up their crypto assets known as staking for a predetermined period. Uh, it's very popular. There is very popular. Even I will take an example of our UBX. We do have stake mining. We also have 7 days, 30 days, 60 days, or even up to 360 days. Okay, so these are the duration that usually allows stake mining to have. So it actually valid it actually allows staker to participate in the network consensus mechanism, validating the transaction and creating new blocks in that platform. So usually user will receive rewards in the form of native tokens or other cryptocurrency based on their staking and network activities. So like for example of UBX actually have this by staking of the USDT to earn the native token called UBX. So from here, the community or participant user will actually able to stake a period of time on their USDT and actually receive UBX and actually can exchange for other assets they want. So let us take a look at how rewards of stake mining actually works. Usually it comes in allow the stakers to earn reward for validating transactions. So some stake mining mechanism also distribute transaction fee to staker to provide for providing additional rewards. Okay, some actually participate in stake mining can sometimes grant access to governance token, allowing holder to vote on the network upgrade. So they were like the shareholders, some of the stake mining programs. Okay, so let us take an example of how the staking platform works versus the bank fixed deposit. Actually, they are very similar, except for bank is actually the platform for fiat currency, and in the staking platform usually is a crypto platform which is actually work on cryptocurrency. So just imagine your crypto is the deposit. So it's just like you deposit in a bank, you can stake your cryptocurrency on the crypto platform. So the staking platform in the bank reference is the platform holds your crypto similar to the bank holding to your funds. So how is crypto being used? So in banks, banks use deposit to lend money or invest to generate profits. So in staking platform, your stake crypto usually contribute to validating transaction and securing a particular blockchain or even a particular network. So they will actually generate rewards and to be given out to the contributor. So bank interest on deposit for allowing bank to use your money, definitely you will definitely need to have some incentive or earn some interest. So this is what the bank do by having you to put some your fund into the bank, and they will actually generate interest and return back to uh, the users. So in crypto, actually, you can earn reward for contributing to the network operating by doing staking. So it's similar. So when you contribute to the network, you are actually part of the platform community. So it has to actually give some reward. If not, no one will actually join this platform for staking any funds or any cryptocurrency or any crypto assets to the platform. So usually bank, they will actually want you to do the fixed deposit to actually increase the interest to you. So it's similar to the crypto. It often also lock for duration, which you cannot draw out. So when this duration increases, that means usually they will actually give higher rewards or better interest rewards. So like banks, at the end of the fixed period, you can withdraw your money and the interest. So for staking period for crypto, you can actually claim your reward daily and withdraw your stake crypto after the fixed period. So let's take a look at the key factor to consider for staking. So staking usually has a lockup period. So the amount of time of crypto is locked for cannot be withdrawn. So this we need to take note. If you require some asset to use for daily, please do not uh, increase the duration for too long. So probably you might choose 30 days or even 60 days. Okay, but if you have funds that you are planning not, you will not be touching them for at least more than a year. Definitely, usually the yearly lock period will definitely provide you with higher APY. Okay, so APY, which is we call as annual percentage yield. So this estimated annual returns can be earned from staking, and it will actually goes higher. The percentage will grow higher when you actually increase the lockup period. And usually, a lot of staking have the minimum sum that you want to choose before you can actually join the staking. So in UBX, I believe we are actually required to have at least 100 USDT to actually do the stake mining. Okay, so how to actually do a setup in the stake mining? Okay, stake mining have comes in different. There is stake mining in centralized platform. There's stake mining in decentralized exchange as well. So if you were to touch on the decentralized exchange, which actually refer to a liquidity pool, you actually need to select a reputable crypto wallet that supports stake mining and choose the cryptocurrency that you wish to do the staking. So usually, I have taught before there is a few wallets like Trust Wallet, MetaMask, TP, Token Pocket. So these are some of the third-party wallets that you can actually access to the app that some allow to do stake mining over the decentralized exchange. So after that, you have to create an account with the chosen wallet and ensure it's securely backup. So remember, always back up your 12-sig phrase for any third-party wallet because you are the owner of the wallet, and the how to recognize the owner is the person who have the 12-sig phrase. So after that, you can actually deposit the desired crypto wallet currency into the wallet and configure the stake mining setting. So different project will come with different setups. So like for UBX, we actually create a wallet for you guys and actually allow you to deposit funds into the wallet and do the stake mining. So it can be extracted. Your funds can be withdrawn to a third-party wallet as well. So as long you follow the step in the system, you can actually choose the network that you want to withdraw from or withdraw as. Okay, so best practice for stake mining. So make sure that you actually has a strong password and enable two-factor authentication for your wallet. So at least if someone were to hack into your phone, they are not able to actually probably get the additional password from the device. So usually, like for UBX, we actually have the two-factor authentication through Google Authenticator. So this I would advise those that is listening over here. Please do the security add, add on your security password by using additional two-factor authentication using the Google Authenticator. So also when you choose the stake mining, you actually need to go through the research the cryptocurrency and the stake mining platform before committing any fund. Okay, I have gone through a lesson about how to actually look at research on the crypto, look at the tokenomics of the token, and actually understand what is the community and the future ecosystem of the mining platform. Okay, so not the last one, probably you might actually look at multiple cryptocurrency to reduce. Let's say if you were to be investing or putting liquidity or staking in Ethereum, and if you have placed all your funds in Ethereum, and probably you might not know, Ethereum actually go down probably 10 to 50%, you make a loss. But not to worry, if you have another pot of funds that is in another token which is appreciating by 10 or 50%, you might actually balance out your risk. Okay, here are some strategies for maximizing stake mining rewards. So remember, usually identify the cryptocurrency first, identify all the cryptocurrency with reputable uh, backgrounds. After study them, make sure and look at their APY, and uh, is the API high enough? Is it to your expectations? You do your own calculations, and before putting in your stakes. Okay, so by also you can join the stake mining pools or platform that provide incentive. Okay, so there is many ways of staking. There is a by going through PancakeSwap, Uniswap. These are the decentralized method. But if you are not so prone to the not so tech savvy, you can actually go through a centralized platform. Okay, centralized platform, most of the exchanges provide the uh, stake mining pools, especially UBX. For our side, we also provide stake mining by staking UBX with USDT. You can actually mine out the UBC. So these are most of the projects coming out with a lot of new tokens that actually can appreciate and have potential. So these are ways of earning mining rewards through programs offered by the platform. So always you can actually do your calculation. You can actually download stake mining calculator. You can actually place the figure in, and actually usually the stake mining will actually give you the percentage that you should be receiving, and you can actually do your own calculation and see how much reward you are planning to earn and make the required strategies. Okay, so let us have some case study on the PancakeSwap. Okay, PancakeSwap actually also is one of the oldest yield farming and staking uh, decentralized blockchains that provide this farming and staking. So actually PancakeSwap we also require a third-party wallet. You can actually go in and look for the tokens that you want to join the liquidity mining. So what happens over here? PancakeSwap actually allow user to provide liquidity and earn the LP token. So the LP token is actually a stake LP token which called as cake. Okay, I give an example. So let's say if you want to join Bitcoin versus USDT, you want to join the liquidity mining. They will actually give, once you place the liquidity pool, they will actually give you a contract stake LP token, a token that actually indicates how much value or uh, how much percentage of liquidity pool that you are holding. So once you have the cake actually they have a program that allow you to stake your cake in a so-called a syrup pool to actually earn more cakes or other tokens. So this staking also requires some durations. So it depends on your own strategies how you want to make. So I'm not promoting PancakeSwap, but I'm just showing you guys that there is this kind of marketing. I mean, this kind of staking involved. So for UBX, we also do have staking involved, which is what I mentioned just now. Um, by by staking UBX with USDT, you can actually earn other token, which is called the UBC. So many other programs in the crypto world are all are providing the stake mining rewards. It's just that how much is the APY we are looking at. Okay, so let us do a summary. We now compare the difference between liquidity mining and staking. So what is liquidity mining? The purpose is actually to provide liquidity for traders to trade or exchange tokens. So staking is actually a kind of secure network operation provided by the platform to allow user to earn by locking their crypto assets. Okay, so what are the rewards like in liquidity mining? So mostly are trading fees or sometimes incentive tokens to be given to the user. So for staking, usually are block rewards or yield. So like for us, our staking is actually by staking USDT, you can actually get rewards in UBX. So liquidity mining, there will definitely be risks. So there might be impermanent loss or token devaluations. So in the liquidity pool, if it happens that a lot of community users are actually removing their liquidity pool, the value will drop, or sometimes even a lot of users are selling their token for another, let's say this pair, uh, Bitcoin versus USDT. If everyone is exchanging Bitcoin for USDT, the price for Bitcoin will definitely drop, calculated by the ratio, but by the automated market maker. So for staking, the uh, risks are actually slashing risks like the protocol failure, the signal, the network is not good enough, then that might be some issues. So usually platform will actually make all their effort to actually protect the security over the platform. So some example are liquidity mining is like Uniswap, PancakeSwap, like just now I mentioned. So there's also Curve. Okay, for staking, there are many platform outside doing staking. Even the Ethereum 2.0, Bidu, Adventurer, and even UBX Exchange are providing staking programs. So let us actually look into some advanced topic in liquidity mining and staking. So nowadays, there is many okay, many programs like dual liquidity incentive platform actually can offer multiple rewards by giving out governance tokens and LP fees as rewards. So some actually have a protocol like Tor chain enable liquidity across multiple chain. So cross chain liquidity are very advancing and very popular nowadays. So there is a very regulatory challenge like many liquidity minings and staking protocols are facing compliance risks due to their unclear regulations. So when you actually look into the liquidity mining, do remember to actually look at the history or even look at the white papers of the particular token. So defined projects are actually moving towards sustainable models based on their real yield rather than the high inflations. So why some platform actually doesn't work well, because probably the the model is not sustainable enough. So they might be overpaying. They might be giving too much rewards to the users. So these are actually need to take note. So if you have seen rewards that is given too high, probably you need to take a look whether is this uh, project safe enough. Okay, so averagely out there, we have to take note that nothing is free. We have to generate, we have to work the community to generate the rewards by keeping the model or keeping the project sustainable. This is the work for every individual or every users in the platform. Okay, like I mentioned just now, some of the risks that we might that might occur, some smart contract risks, because in the decentralized world, we there is no one in charge of the particular smart contract. So it's actually all the liquidity pool is provided by every individual around the world. So we won't know that whether this particular token, whether does it owned by a singular person that actually wants it it can actually take out all the tokens or probably sell all the tokens from their side, and the price will drop, will fall drastically. Or even some developer actually pull up, uh, withdraw all the liquidity from the pool and leave the token worthless. So do take note and read through the white papers and understand about the project before doing any decisions. So in conclusion, we have to look, this is the future of the DeFi world. So liquidity mining and staking are the property that drives the adoption of the DeFi. So decentralized is a word, DeFi is the word now that allows uh, decentralized finance people to earn from this crypto financing world. So the emerging trend are, just like I mentioned, the cross-chain liquidity, uh, or looking at substantial incentive, or even evolving with regulation or shaping the future with some AI technology, or a longer uh, ecosystems that will be provided in the platform. So when we actually look at our UBS platform, if you guys notice, we are actually keeping up with the trend. We are working towards AI technology, especially now we have this UBC. So UBC is actually a AI technology that offers translation programs, products that this allow us to actually earn rewards through supporting this program. So this is the kind of staking programs that actually a lot of user might want to see, because there is innovations around. So when innovations around, community will comes in and invest and stakes. Uh, once they believe the coin will have value, everyone have the same consensus, then this will actually works, and it will actually UBX will actually comes in with a lot of other programs or other products in to our exchange to attract more users. So with more users, it will definitely be better for UBX platform. So the key takeaway for tonight. So we have to take note, liquidity pool and stake mining offer exciting opportunity for passive income in the crypto space. However, it's crucial to understand the concept, benefit, and risk associated with these tools. So you need to actually conduct your thorough research, following best practice, and also implement strategy. So this you can actually navigate these power tools effectively to maximize your rewards. So you guys actually, if you are interested in actually looking into the UBX platform, please do take note. We are having our uh, the opportunity session over on Wednesday, so you can actually invite your friends to join our podcast and actually understand what is the UBX staking programs, and also what are the rewards the UBX are offerings. So uh, so tonight I will end my podcast. Thank you for joining me and listen to the Crypto 101 for tonight. And have a good day. Thank you.